Listen, I'm going to be brutally honest with you right now. While everyone's chasing the next hot stock or listening to some Discord guru promising rocket ship returns, there's one boring investment sitting right in front of you that has been crushing it quietly for decades. And if you only buy one ETF this entire year, this is the one that could literally change your financial future. Stick with me because in the next few minutes, I'm going to show you exactly why this pick beats everything else out there. And I promise you by the end of this video, you'll understand why the smartest investors keep coming back to this strategy over and over again. And hey, if this resonates with you, smash that like button right now so we can reach more people who need to hear this message. Don't forget to subscribe to Stock Vibe because we're building something special here, a community that actually focuses on building real wealth instead of just talking about it. The costly mistakes most investors are making now, before I reveal the ultimate ETF pick, let me tell you something that's going to shock you. Most investors are bleeding money right now and they don't even realize it. They think they're diversified. They think they're playing it safe, but they're actually making the same costly mistakes over and over. You see, there's this massive gap between what investors think they own and what they actually own. Take the NASDAQ 100, for example. Everyone treats it like it's this pure tech growth machine, right? But here's the dirty little secret. Almost a third of that fund isn't even tech stocks. You've got companies like Costco and Pepsi dragging down your returns. Now, don't get me wrong, I love a good hot dog from Costco as much as the next guy. But when I'm hunting for explosive tech growth, I'm not looking to invest in grocery stores and soda companies. And this brings me to something critical. The difference between a good ETF and a great ETF is not just about the returns you see on the surface. It's about what's actually under the hood. It's about understanding what you truly own and whether those holdings align with your goals. Because here's the thing, a 1% difference in fees might not sound like much, but over 20 or 30 years, that's literally hundreds of thousands of dollars staying in your pocket instead of going to some fund manager's yacht payment. Think about that for a second. The same investment, the same time horizon, but one choice puts a beach house in your future, while the other choice steals it away, one tiny fee at a time. Top ETF contenders for 2026 now. Let me walk you through the top contenders for 2026, and then I'll reveal which one takes the crown. Real estate ETFs, XLRE. First up, real estate. The State Street Real Estate SPD, our ticker XLRE, has been absolutely hammered over the past few years. We're talking about the worst performing sector with only a 14.4% return over 5 years. That's embarrassing compared to energy's 136% or tech's 124%. But here's where it gets interesting. Smart money is starting to pour back in. For the first time in 3 years, commercial property investors bought more than they sold in 2025. They scooped up $4.6 billion in U.S. property. You know what that tells me? These assets got so cheap that the professionals couldn't ignore them anymore. And when you look at the fundamentals, there's this massive disconnect. These companies grew their earnings by 9% annually, but the stock prices barely moved. That's trapped value just waiting to explode when sentiment shifts. Plus, you're getting a 3.3% dividend yield while you wait. That's real cash hitting your account every quarter. Tech ETFs, IGM versus QQQ, but real estate isn't for everyone. Maybe you're younger, maybe you've got time on your side and you want pure growth. That's where tech comes in. but not the tech ETF you think. Everyone's piling into QQQ, the NASDAQ 100 fund with $400 billion sitting in it. But there's a better option that most people don't even know exists. The iShares Expanded Tech Sector ETF, ticker IGM, is all tech all the time. No grocery stores, no beverage companies, just pure technology firepower. 278 companies across hardware, software, internet, everything driving the future. And get this, over 5 years, IGM beat QQQ by 28%. That's an extra 5% return every single year just by choosing the right fund. The difference compounds into serious wealth over time. Target date funds now, if you're someone who wants to set it and forget it, target date funds might be your answer. These things are genius for people who don't want to think about rebalancing or adjusting their stock-to-bond ratio as they get older. You just pick a fund that matches when you plan to retire, and it automatically adjusts from aggressive growth when you're young to more conservative protection as you approach retirement. It's like having a financial advisor built right into the fund, except it costs you a fraction of what an actual advisor would charge. If you're 5 years from retirement, you want something like the 2030 fund with 53% stocks and 47% bonds. If you've got 20 years, go with the 2045 fund at 87% stocks. The fund does all the heavy lifting for you. Income ETFs, GPIQ. But let's talk about income because this is where things get really interesting for a lot of you watching right now. Maybe you're at that stage where you need your portfolio to start paying you instead of you paying into it. The Goldman Sachs NASDAQ 100 Premium Income ETF, ticker GPIQ, is throwing off almost 10% in dividends right now, 10%. But here's what separates it from all those other high-yield traps out there. It's actually growing your wealth at the same time. Over the last year, it delivered 7% in price appreciation on top of that massive dividend. Compare that to some of these other income funds that are literally destroying your capital while they pay you. It's like taking money out of your left pocket and putting it in your right pocket while pretending you're getting richer. GPIQ is different because it uses covered calls on the NASDAQ 100, capturing premium income while still participating in market upside. It's sophisticated, it's effective, and it's exactly what income-focused investors should be looking at. Using ETFs as research tools. And here's something most people miss completely. You can use these ETFs as research tools for individual stock picking. Every single fund lists all its holdings. You can download that data and mine it for the best opportunities within each sector. It's like getting free research from professional fund managers who've already done the work of screening thousands of companies. You're essentially standing on the shoulders of giants, using their due diligence as your starting point. That's a strategy hardly anyone talks about, but it's incredibly powerful. Blockchain ETFs, BLOK. Now, before I reveal the top pick, let me throw one more contender into the ring. The Amplify Blockchain Technology ETF, ticker BLOK. This isn't just about buying Bitcoin or Ethereum and hoping for the best. This fund owns 55 companies that are actually building the infrastructure of the future of finance. You've got platforms like Robinhood and Coinbase, miners like Riot and Hut 8, applications being developed, and even venture investments you couldn't access on your own. Only 12% is direct crypto exposure. The rest is real companies generating real profits by leveraging blockchain technology. Even if you're conservative, even if you're close to retirement, You need some exposure to this theme. Finance is being rebuilt from the ground up, and you either ride that wave or you get left behind. The number one ETF for 2026. So now comes the moment you've been waiting for. What's the number one ETF to buy in 2026? After analyzing returns, fees, holdings, and future potential, here's my answer. If you're going for pure, simple, long-term wealth building, nothing beats a total market index fund. Something like VTI, the Vanguard Total Stock Market ETF. You get instant exposure to over 3,000 companies from mega-cap giants to small-cap innovators. You own the entire U.S. economy in one fund. The expense ratio is just 0.03%, meaning you keep almost everything you earn. And historically, over 90% of professional money managers failed to beat this simple strategy over 15 years. You're not trying to outsmart the market. You're accepting that the market itself is smarter than any individual. It's boring. It's not sexy, but it works relentlessly. But here's the thing, and this is crucial. The best ETF for you depends on where you are in life and what you're trying to accomplish. If you need income right now, GPIQ might be your winner. If you're young and aggressive, IGM could be perfect. If you want hands-off simplicity, target date funds are incredible. If you believe in the blockchain revolution, BLOK deserves a spot. The point isn't that there's one magical answer for everyone. The point is understanding what each of these tools does and using the right one for your situation. My personal investing journey. Now, let me share something that changed my entire investing approach. When I first started investing years ago, I made every mistake in the book. I chased hot stocks. I listened to tips from random people on the internet. I bought high and sold low out of fear. I watched my portfolio swing wildly while my stress levels went through the roof. Then I discovered the power of ETFs and everything changed. The peace of mind that comes from knowing you're diversified across hundreds or thousands of companies. The confidence that comes from owning proven strategies backed by decades of data. It's a complete game changer. You stop checking your portfolio every 5 minutes. You stop panicking when one stock crashes because you own hundreds of others that are doing fine. You actually start sleeping well at night. And here's what really blows my mind. The wealthiest investors in the world, the ones with billions of dollars, they're not day trading penny stocks or chasing meme coins. They're using the exact same boring index fund strategies I'm talking about right now. Warren Buffett, one of the greatest investors of all time, has repeatedly said that when he dies, he wants 90% of his wife's inheritance put into a simple S&P 500 index fund. Think about that. The man who built an empire through stock picking is telling his own family to just buy the index and forget about it. That should tell you everything you need to know about what actually works. Addressing the skeptics, but I want to address something important because I know some of you are thinking, this sounds too simple. There must be a catch, and you're right to be skeptical. The financial industry has spent decades convincing people that investing needs to be complicated, that you need expensive advisors and complex strategies and insider knowledge. You know why? Because simple doesn't make them money. When you buy a low-cost index ETF and hold it for decades, nobody's getting rich off your fees. But when they convince you to constantly trade, to buy their expensive, actively managed funds, to chase the latest hot sector, that's when they make bank. The truth is, simplicity is your superpower as an investor. Complexity is usually just expensive noise. 3 rules for successful investing. Let me give you 3 rules that will serve you better than any fancy strategy out there. Rule number 1, start now. Time in the market beats timing the market every single time. People waste years waiting for the perfect entry point, waiting for a crash, waiting for clarity. Meanwhile, the person who just started investing with whatever money they had is building wealth through compound growth. Even if you start at a market peak and it crashes the next day, if you hold for 10 or 20 years, you'll almost certainly be profitable. That's the power of long-term investing. Rule number 2, invest consistently. Set up automatic investments every month, every paycheck, whatever works for you. This is called dollar cost averaging, and it removes emotion from the equation. You buy when markets are high, you buy when they're low, and over time, you average out to a reasonable price while building a massive position. Rule number 3, ignore the noise. The financial media makes money from keeping you anxious and engaged. Every day there's a new crisis, a new reason to panic, a new prediction of doom. Turn it off. Your job as a long-term investor is to stay the course while everyone else is losing their minds. The real secret to building wealth, and I want to share one more insight that most people completely miss. The real wealth isn't built from picking the absolute best performing investment. It's built from avoiding the terrible ones and staying consistent with the good ones. You don't need to find the next Amazon or Apple. You just need to avoid blowing up your account on garbage investments while steadily accumulating shares of solid ETFs. The person who gets 50% of the maximum possible return but does it consistently for 30 years will absolutely destroy the person who chases 100% returns and ends up with zeros and negative years scattered throughout their journey. Consistent mediocrity beats sporadic excellence every single time in investing. Your action plan. So here's my challenge to you. Pick one of these ETFs based on your situation and goals. Just one. Set up an automatic investment plan and then do the hardest thing of all, leave it alone. Check in once a quarter if you must, but resist the urge to constantly tinker and adjust and second-guess yourself. Give your strategy time to work. Give compound growth time to work its magic. I promise you, 5 years from now, 10 years from now, you'll look back and thank yourself for having the discipline to stick with a simple, effective plan. And listen, I want to hear from you. What ETF are you buying this year and why? Drop a comment below and let's start a real conversation. If you found value in this breakdown, hit that like button and share this video with someone who needs to see it. Your engagement helps us reach more people who are serious about building real wealth. Subscribe to Stock Vibe if you haven't already, because we're just getting started with this series. We're going deep on stocks, bonds, growth themes, everything you need to build the perfect portfolio for 2026. If you have any questions about ETFs or investing strategies, drop those in the comments too, and I'll do my best to answer them or make a follow-up video addressing your concerns. Final thoughts, the bottom line is this: investing doesn't have to be complicated. It doesn't require genius-level IQ or insider connections. It requires discipline, patience, and choosing the right vehicles to carry you toward your goals. ETFs give you professional-level diversification at bargain basement prices. They eliminate single-stock risk while capturing entire sectors, themes, or markets. They compound your wealth quietly while everyone else is chasing headlines and losing money. That's the power of smart, boring, effective investing. So stop overthinking it. Pick the ETF that matches your goals. Start investing consistently and let time do the heavy lifting. Your future self will thank you for making the smart choice today instead of gambling on whatever is trending on social media tomorrow. Now, go build that wealth.